Understanding financial statements. There are three primary financial statements that you need to have a clear understanding of, whatever area in business you decide to go into. First is your balance sheet, second is your income statement, and third is your cash flow statement. The purpose of the balance sheet is to show what a company owns and what it owes at a fixed point in time. Comparing it to a personal balance sheet, it would be what you owe, what your assets are versus what your liabilities are. And the difference is what your net worth is, and the balance sheet shows your net worth. An income statement shows how much money a company made and spent over a period of time. It's designed to show the overall progression of money and where it goes. And finally, the cash flow statement, that shows the exchange of money between a company and the outside world over a period of time. It would be the equivalent of your monthly checkbook. Or if you keep a spreadsheet of your income and where your money goes each month so that you can keep with your budget, it would be similar to that. Let's take a closer look at each one of those documents. We'll start with looking at the balance sheet. So as we mentioned before, a balance sheet provides detailed information about a company's assets, liabilities, and stakeholder equity. You're probably going, what? Let's explore each one a little bit more. The top part of your balance sheet is the assets, and those are things that the company owns that have value. They're usually listed in order of liquidity, so how fast something can be turned to cash. If you had to leave the country quickly, how fast could something be sold or be converted to something that you could take with you? Assets usually include physical property such as plants, trucks, equipment, inventory. When I say plants, I mean buildings. It also includes things that can't be touched but exist, like trademarks, patents, and investments that a company makes also are considered assets. The next area down is liabilities. And with liabilities, those are the amounts of money that a company owes to others but hasn't yet paid. It can include all kinds of obligations. It can be money borrowed from a bank to maybe launch a new product, a rent for a building that's owed, money that's owed to suppliers for materials, or payroll that's owed to employees. It can even include taxes owed to the government. And then the bottom section is stockholder equity, or shareholder equity, stakeholder equity, whatever. And it's called capital or net worth, and it's all the money that's left over if a company sold its assets and paid off all of its liabilities. Because the money, well, it belongs to the shareholders or the owners of the company. Total liability, so the money that you owe but you still have, plus shareholder equity, the money that you get to keep after you've paid everybody, it equals your total assets. And that's everything all together. The next document we're going to look at is an income statement. And reminder, an income statement is a report that shows how much revenue a company has earned over a specific period of time. Usually it's a quarter or in a 6-month period. Most commonly it's annually, so once a year. And it shows the costs and expenses that are associated with how the income was earned. So to understand an income statement, think of it as a set of stairs. You start at the top with your absolute total amount, and each time you step down, you're taking bits of that away until you get to the final end result. And that's also why they call it the bottom line, because it's the bottom of, well, the stairs. The top portion is the total revenue. It's the total amount that was brought into the business during the time that we're looking at. Next on the list is cost of revenue, and that's your cost of goods sold, or what it cost for you to create the items that you have sold. and that gives you your gross profit, or your gross margin, it's sometimes called. It's considered gross because there are certain expenses that haven't been deducted from it yet, but it's considered gross profit because it's not the full amount of money. And the next portion that comes out are called the operating expenses, and they are all of the day-to-day expenses that go specifically into operating the business itself. And that's often called income from operations instead of total operating expenses. Sometimes that line will read income from operations. The next section is income from continuing operations, and that's sometimes set up differently in different statements depending upon how the business sets up their books. In this case, you have your earnings before interest and taxes, which is the $1,890. Then you subtract your interest expense, which gives you $1,561, and then income tax expense, which is $575, which gives you net income from continuing operations, $986. The bottom portion is non-recurring events, and those would be one-time charges that would affect this specific income statement but would not be on every income statement. What's left is your net income, also known as your net profit or net earnings, and it tells you how much your company actually earned or lost during that specific accounting period. The last document that we'll review is the cash flow statement. And reminder that the cash flow statement reports the company's inflow and outflow of cash. So this one is usually run more often, although the one that we're looking at here is an annual cash flow. So it shows the total inflow and outflow for each individual area within the business. It's important to be able to know the inflow and outflow of cash because a company needs to have enough cash on hand to pay its expenses and to purchase assets. An income statement can tell if the company's made a profit, but it's the cash flow statement that tells you whether the company is generating cash. And a cash flow statement shows changes over time rather than an absolute dollar amount at a specific point in time. So in this cash flow sheet, you see that with depreciation and changes in inventory, we end up with an increase to $1,265. Investing activities is the second part of the cash flow statement, and that shows the cash flow from all investing activities. Generally includes purchases or sales of long-term assets such as property or equipment. If a company buys a piece of machinery, for example, the cash flow statement would reflect this activity as a cash outflow because cash was used. If a company decided to sell off something, it would show as a cash inflow because cash was brought into the business. The third part of the cash flow shows cash flow from all financing activities. Typical sources include selling stocks and bonds, more commonly borrowing from the bank. Just as an FYI, paying back a bank loan would show up as a use of cash flow. The bottom line of your cash flow statement shows the net increase or decrease in cash for the period.